So, have you checked your core portfolio lately and thought, why on earth isn't my cash growing like it used to? Well, welcome to our explainer on the Citi Private Bank Playbook. Today, we're diving straight into how macroeconomic policies are quietly but actively targeting your wealth, and more importantly, how we can actually restructure and fight back. To understand what's happening, we need to unmask our main villain today: financial repression. It's this one-two punch where central banks keep interest rates artificially low for way longer than usual, while at the same time letting inflation run hot. If you're a highly indebted government, this is a dream scenario. It's basically a way to silently melt away massive debt burdens over time. The real value of what they owe just evaporates. But what does this actually mean for us? Well, Citi Private Bank puts it incredibly bluntly in their research. They call it a forced transfer of wealth from bondholders and everyday savers straight to borrowers. Seriously, think about that. If you're just sitting on excess cash or traditional low-yield bonds, you are literally the one footing the bill to reduce global debt. To stop footing that bill, we need a solid plan. So here's our playbook to help your portfolio thrive right now. First, we'll look closer at this financial repression threat, then see how equities are working overtime, move into finding yield in bonds, explore alternative paths to income, and wrap up with creating yield from volatility. All right, Section 1, the financial repression threat. Let's jump into the history of this invisible tax and look at the cold, hard data that proves it's happening as we speak. Now, what's genuinely fascinating here is how exactly the post-World War II debt situation mirrors our post-pandemic economy. This is not a new trick. Back after WWI from 1942 to 1951, the Fed explicitly capped long-term rates while inflation just surged, all to shrink those massive war debts. Get this, an investment in a 10-year treasury back then would have taken nearly 40 years to give you a positive return after inflation. 40 years. Today, we're seeing them run the exact same play, keeping rates atypically low while stimulating the recovery to shrink that modern pandemic debt. And the fallout from all this? Negative real yields. It's a harsh reality check. Holding cash or those once reliable U.S. Treasuries is currently a guaranteed way to lose your purchasing power to inflation. When inflation runs hotter than your interest rate, your money is, quite literally, shrinking in value every single day it just sits there. It's a brutal uphill battle for everyday savers. Honestly, it feels like trying to push a massive boulder up a steep staircase when inflation is just constantly outpacing your returns. So, sitting on the sidelines, waiting for some magical better entry point, that's just not an option anymore. We absolutely need a deliberate, major shift in our asset allocation to protect our money. Which brings us right to Section 2, equities working overtime. Let's look at our first strategic move and see how stocks are basically being forced to do the heavy lifting to generate your income. Since traditional bonds are kind of dropping the ball in yield right now, stocks have to step up. Citi's playbook suggests blending two very different flavors of dividend-paying equities. On one side, you've got your dividend growers. Think of these as the reliable workhorses, companies that consistently bump up their dividends over time, usually with lower volatility. Then, on the other side, you have your high dividend yield equities. These are often cyclical companies, maybe international stocks or real estate, that hand you a much higher immediate payout. Blend these two together and you get this great balance of steady, long-term growth plus immediate, punchy yield. And this pivot makes total sense when you just look at the numbers. The dividend yield on global equities is sitting right around 3%. That is double, literally twice as much as the global bond aggregate yield, which is stuck around 1.5%. Plain and simple, equities are just offering a superior income stream right now, which makes them an absolutely crucial stand-in for traditional fixed income. All right, Section 3, finding yield in bonds. Because despite everything I just said, we aren't totally abandoning the fixed income battleground just yet. I mean, let's be real. Navigating the modern fixed income market is incredibly complex. It almost feels surreal. That old school safe haven bond market we all grew up with, it's fundamentally changed. You can't just buy a generic government bond and expect a real return anymore. Instead, we have to go hunting in some pretty unusual, highly specific corners of the market to find yield that actually beats inflation. One of those unusual corners, fallen angels. Great name, right? These are investment-grade corporate bonds that hit a rough patch and just got downgraded to high yield or junk status. Now, when that downgrade happens, their price usually tanks. But that creates a really compelling opportunity for total return, especially as the company fights to fix its balance sheet and get its rating back up. The whole point here is that we need to actively hunt for these specific, mispriced assets instead of just blindly throwing money at broad, low-yielding index funds. Citi's research also points us toward a few other bond-like alternatives, provided you're comfortable with the risks. For example, preferred securities. These kind of sit in a sweet spot between equity and traditional bonds, and they can yield around 4 to 5%. Then you have non-agency residential mortgage-backed securities, yielding close to 4%, and mortgage REITs. Now, those REITs use leverage to boost yields, so they definitely pack a bit more volatility. But the name of the game here is intelligently diversifying where your income is actually coming from. Which naturally brings up a really valid question. If yields are this terrible and inflation is just eating them alive, why on earth should we hold high-quality bonds at all? Why not dump them? Well, even with those negative real returns, top-tier government bonds are still one of the only truly reliable hedges when equity markets suddenly nosedive. Think of them as your portfolio's shock absorbers. So keeping a strategic, even if it's much smaller, allocation is still highly recommended, just to cushion the blow if stocks suddenly drop. Moving right along to Section 4, Alternative Paths to Income. Let's step away from the public exchanges and explore the private markets for those of us willing to trade a little liquidity for some higher potential returns. Check this out. There has been an absolute explosion in the private debt market. We're talking about a $1 trillion global market that has literally quadrupled in size since 2007. It's wild. After the 2008 financial crisis, banks got hit with massive regulations and really pulled back on lending. Well, nature abhors a vacuum, right? Non-bank financial institutions rushed in to fill that void, and that created this massive structural opportunity in private debt. Now, for qualified investors, these alternative strategies can hand out intermittent but really substantial distributions. It's a fantastic income substitute. We're looking at things like corporate direct lending, which can offer you incredibly impressive margins, like 550 to 650 basis points over government bonds. You've also got structured credit, which basically profits off the illiquid gaps left behind by those retreating banks. And then there's fixed income relative value, where hedge funds use arbitrage to basically piggyback on massive central bank interventions. Ultimately, this is about exploring entirely new delivery mechanisms for your yield. If you can look past traditional public markets, and if you can stomach sacrificing a bit of daily liquidity, you can tap into yields that haven't been completely distorted by central bank buying programs. It's a totally different landscape, but one that is absolutely vital right now. And finally, Section 5, Creating Yield from Volatility. Let's look at how we can actually weaponize market fear to generate income. Take a glance at the VIX index, which has been stubbornly hanging out in the mid-20s. If you're not familiar, the VIX is essentially Wall Street's fear gauge. It measures equity volatility. And what's wild is that this mid-20s level is roughly double its pre-COVID historical average of about 13. People are nervous. They expect turbulence. And because of that fear, they are willing to pay a hefty premium to protect their portfolios. And guess what? We can capitalize on that exact fear. Certain capital market strategies let you extract yield from the massive premiums those nervous investors are paying to hedge against a crash. Think about it. Instead of just sitting on cash, waiting around patiently for a market dip so you can finally buy in, you can use specific option strategies to actually get paid an income just for waiting. You are essentially playing the role of the insurance company, selling the exact protection that fearful investors are desperate to buy. It creates this beautifully rare scenario where the financial stars just kind of align. When you combine high market volatility with rock-bottom interest rates, the math flips. The relative value of seeking income from that volatility, literally getting paid to wait, becomes so much more compelling than just settling for 0% on cash sitting in a bank account. As we've seen today, that old-school playbook of just relying entirely on standard bonds, it's broken. It doesn't work anymore. Overcoming this threat requires a deliberate, proactive approach. You have to intelligently mix those dividend growers, alternative fixed income, private debt, and volatility strategies. So I highly encourage you to take the concepts we've unpacked today and take a hard look at your own strategies, because you really have to ask yourself, is your core portfolio actually adapted to defeat financial repression, or are you still silently paying the invisible tax?